We're going to start today with a conversation with Nate Redmond, Managing Partner of Alpha Edison in Southern California. Nate, welcome. It's great to have you.
Thank you so much. It's a pleasure to be here.
So Nate, tell our audience about Alpha Edison and yourself. Just let's introduce you to the audience, and of course for me also some catching up, because the last time we spoke you were doing something else and you were in the middle of putting this new thing together. So let's catch up.
Thank you so much. So Alpha Edison is a new firm. We're about 2 years old, and the focus and how we invest is really a function of the type of business model innovation that we look at. So unlike most investors, most venture capital investors who tend to look for and focus on either sector expertise, so for example, digital media or fintech, or they look at kind of technology waves, for example, mobile. Our belief is that these have ceased to become real sources of differentiated insight. And instead, we look through much more horizontal lenses that cut across traditional sectors and end up really driving and shaping business model innovation. And the power of that business model innovation is that it allows you to unlock new markets, and unlocking those markets is really the power of long-term sustainable growth.
So that's an abstraction. Can we double-click down and work on an example that illustrates the philosophy that you just outlined? I think that would be helpful.
So, when we started the firm, we really set out to answer a very specific, simple question with a complex answer, which is, why is it that most investors miss most of their best opportunities? And so an investor is known and has been very successful largely on the basis for a small number of investments that they've made and companies that they've been part of building. And yet, if you look back through their career, despite having invested in 2 or 3 companies that went on to be very successful, they actually saw another 10 or 12 or 15 or 20 that were equally, if not more successful. Mm-hmm. And that, that's partly a byproduct of the fact that you see many, many companies as an investor. But you turn it around and look at a company like Airbnb, and why is it that so many investors saw and yet didn't have conviction in order to move forward and make an investment? Of course, as you move forward and things become obvious, it's reflected in the price. Even for those who came in and billion-dollar-plus valuation, that was a smart move. But we really focus on the earlier stages. And when you look at a company like Airbnb, it's very easy when you're kind of sitting 10 years later to look at how obvious things seem today. But when you roll back to when this team really started the company, it was clear that they were looking at a market of hospitality that was quite significant. Yet, if you look at the behaviors that they were targeting, these behaviors were really required an individual to come into a home with someone who they didn't know and to stay probably on an airbed. And as such, it was a behavior that really appealed to or fit for a very narrow slice of the population. Consequently, investors, including myself, sat and looked at the company and didn't quite understand the size and scope of the opportunity. And it wasn't because being an investor or an expert in hospitality didn't necessarily help you. In fact, it probably created blind spots. So the area and the focus for us is really understanding how, in this case, the business model around in a marketplace, more specifically around how you can engage a supply base, organize it to really unlock a large portion of latent demand. And in order to unlock that latent demand, it really requires understanding the types of behaviors that people would like to engage in, would like to perform, and yet aren't because they're otherwise constrained. In the case of Airbnb, one of the most important elements that unlocked that behavior was a sense of trust. And so, for example, trust for us has become one of these foundational layers and lenses that we look through to really understand how is it that you can establish and build trust once you do within the context of the market that you're going after, let's say financial services or health. What types of behaviors, new behaviors emerge, and what does that allow you to do in terms of reshaping the business model within that industry?
So that means that you are looking for markets, to take the Airbnb example, where trust was obvious in a very small segment. The larger, the broadening of that trust equation took time, and you are committing to extrapolating and thinking through that trust equation on a longer term basis.
Yeah, that's exactly right. And when we look at the lack of trust that existed within the context of any one of us individually going into someone's home who we did not know, and the framework through which we can begin to establish and build that trust through rating systems, through the way in which Joe and the team really developed and built product, allows us to begin to understand and estimate the scope of the market opportunity that exists if you're able to establish and build that trust. And again, for us, this is less about actually going in and taking share from incumbents. While that's always part of it, what actually drives the long-term sustainable growth is much more unlocking these behaviors.
Value.
So, yeah. So, for example, again, using ride-sharing as a framework, before Uber and Lyft, et cetera, began, again, let's roll back 10 years, the total spend in the Bay Area on taxi and limousines was $140 million. Last year, already more than $1 billion was spent in the Bay Area across ride-sharing. And so this is not a growth curve that is reflective of just going in and taking share. It turns out that a lot of people wanted to move from point A to point B without driving. And consequently, they either previously drove themselves with a set of frustrations, or they just didn't go at all. And by removing friction, by creating trust within the system, you actually unlocked a set of behaviors that colored and described a market that was much bigger than people realized. And that, just to tie the loop on it, that failure to understand the size of the market opportunity oftentimes causes investors not to have conviction as to why Airbnb could be large, and therefore miss most of their best opportunities. Yeah.
So that tells me that you are focusing mostly on B2C. Is that a correct observation?
So consumer businesses clearly have an application of this, but we've also found that there are many business-oriented companies that are servicing businesses that also, their customers fundamentally are servicing consumers, and or the changing behaviors of the underlying consumers actually shape and reshape the markets that they're targeting. For example, I have invested, previously I was with a firm called Rustic Canyon. In that time, I invested in a company called Gaikai. Gaikai had looked at the changing dynamics of streaming, enabling very different modes of gameplay. Of course, that's fairly obvious today. at that time, it was less obvious. That shift in the enabling technology, but fundamentally shaped by the desire by individuals to play interactive entertainment, fundamentally games, without requiring that to be loaded onto your computer or to your Xbox, et cetera, but really to be played online, was what drove it, even though a company like Gaikai really sold through large partners like Sony and LG.
Mm-hmm. Nate, what about stage? What are you looking to see? Are you investing in concepts? Are you investing in a little bit of something, a little bit of traction? What is comfortable?
So, stage has been a segmentation that many investors use that is, I think, reflective of a type of process, both in terms of sourcing and an understanding of a business. We are early stage investors. By that we mean we tend to be investors in we are the first institutional investors in a company. In many cases, this company will have raised angel and or seed money. In some cases, that will have been called a seed round. In some cases, it will have been called an A round. But most importantly for us is really understanding the type of risk that describes where this company is and the type of risk that we really want to own at this stage. So we aren't religious about it being called a Series A. We are really focused on partnering deeply with an entrepreneur in a way that we seek to become that entrepreneur's first call. So it's fun when things go well.
My question is more about what do you want to see in terms of validation to be okay with investing in a company?
Yeah, so it's really not about any one specific set of metrics. If you're a company that is going in and targeting consumers in financial services, we have a very specific thesis. When we talk about trust is evident by things such as very high NPS, very low churn. And those are important. Obviously, NPS affords you the opportunity to build a base of customers without spending lots of money on marketing. Very low churn creates this long-term durable relationship. So having that context, we will focus more on those metrics and looking at the long-term establishment and creation of value, as opposed to what's the trailing month-over-month growth, which frankly anyone fresh out of school can look at and make an early assessment. And that differs, Smrana, from the way in which we would think about a business in a very different space. So clearly it is more important to understand how the pace of learning for an entrepreneur, for a company, the mode of development, and how that maps to the long-term vision. We've spent a lot of time and effort and work around in our focus on business model innovation on how we understand the full potential of a business and the path by which we can unlock that full potential.
Okay. What about fund size and check size? How big is Alpha Edison and what size checks are you comfortable writing?
So we really will invest, our kind of core investments tend to be somewhere between $2 and $10 million. Those aren't hard ranges, only to kind of provide a bracket and a set of areas of focus. Sometimes we come in a little earlier with a very clear thesis on how we begin to unlock that upside. If we do come in earlier, it's with the hope and intent that we can lead the subsequent round and do so in a way that is consistent with the execution pace and our thesis, again, around how you will unlock that upside. And so, we are that maps back to the notion of being early stage investors.
How big is the fund?
175.
175 million. And geography, you are based in Southern California. Is the investment preference also Southern California, or do you have a broader preference?
We are based in Southern California. That really does afford us a view and a set of opportunities to dig in around Los Angeles. That said, we are not a regional fund. We actually don't believe that regional strategies are sustainable over the long term as a point of differentiation. And instead, we have really looked through these lenses at the very best companies reflective of our theses. So we have investments in Los Angeles. We also have in San Francisco, in New York, and Seattle to date.
Okay. Talk about some of the highlights of your portfolio. What have you invested in that you're excited about right now?
Well, we're a new firm, so we're excited and have been fortunate to watch the real development and the early development of our portfolio. There's a company called House Canary in San Francisco, which I'll mention, in that we have a belief and a thesis that residential real estate, which as an asset class is larger than equities in the United States, is one that, despite its size and fragmentation, or perhaps because of it, has a level of opacity that is fundamentally different than what you would see in the equity or credit markets where transparency has come. And as transparency has come to those markets, transparency around pricing of an underlying security, of how to trade those securities, of how to actually transact, and the friction has come down, you've seen a very significant increase in velocity of transactions. So when you look at residential real estate, the behaviors that people have exhibited around how frequently they move and the strategies that they take to manage that home has been, has really not changed over the last 25 years. And at its core is the fact that very few people really understand what their home is worth. So if you start by building a clear sense of value of that home, you can begin to not just chip at the edges of improving the existing process, but actually begin to rewire the entire transaction process. And that's what House Canary set out to do. We are incredibly excited about the long-term prospects for the company.
And if you look back, you've been doing this fund now for 2 years with this investment thesis. What have you seen in the deal flow that could be called trend lines? What are the dynamics of your deal flow? And what does that say about the industry?
So again, we came in with a thesis based off of the last 15 years that most investors have sought to differentiate themselves on the basis of access. And while access remains very important, it's no longer sufficient to really drive differentiated insight and performance. So in other words, the fact that you could see Airbnb was important, but it turns out lots of people saw Airbnb. So actually just having access wasn't the core differentiator. It was really having a strong enough point of view around where this company could go and how it could emerge that actually shaped the long-term performance and was reflective in this case of Sequoia having the conviction to move early. When we looked at our deal flow, one of the dynamics that's changed across the venture capital industry, and it's important just to understand for entrepreneurs, is that it's similar to the way in which our email inboxes have changed over the last decade. where you've had almost an order of magnitude increase in terms of the number of things that are hitting your inbox. Similarly, you have just an explosion in terms of the number of companies. For most people and most firms, that causes the sort of standard traditional filters to just become overwhelmed. The byproduct of that, of course, is that most people fall back on these heuristics on, gosh, I'd love to talk to you. Can you just make sure you get a recommendation for someone I know? Or if you get introduced by a CEO within our portfolio, then I'll focus and take a look. You know, that's an easy point to rely on. We believe that that causes you not only to miss really important developing opportunities, but frankly causes the investment process to tend to focus back in on, you know, people who are introduced tend to be like you. Most VCs are white males, and therefore most entrepreneurs who get introduced by their friends are white males. And so we're really focusing on different ways of opening up the top end of our funnel and having a very efficient and effective manner by which we can work through a process to really engage a much broader array of entrepreneurs.
So do you have a layer of principals or associates who are fielding a much larger inflow of deals?
We do have a really incredibly talented team that we've begun building, but we've also, a lot of this is a focus on systems because, you know, people reach their scale limits very quickly, and you know, the judgment that we're developing is one that we're really intending to accentuate and to accelerate through the systems that we have.
Yeah. It's actually, unfortunately, the industry is very, very hard to break into for people who are, you know, completely coming cold into it from random outskirts and find their way in. So we definitely try to bridge that problem for our entrepreneurs, and our entrepreneurs are not just white male at all. It's very, very diverse community. So
yes,
Nate,
and I've always had just to be clear, I've always had a lot of respect for that and for the community that you've collectively built here. So it's really wonderful to be a part of it.
Thank you. So Nate, comment on unicorn mania for me. We just kind of went a little bit crazy with this concept of unicorns, and then everybody needed to be a unicorn, and it's just a very unfortunate twist that the industry has taken. How do you parse unicorn mania?
Well, look, you know, unicorn status, if you will, became a marker of success that obviously is artificial in many ways, in that and flawed, and you know, it's certainly evident of developing one measure of value, which is reflective of an investor or a group of investors' willingness to buy shares at a price. Clearly, it doesn't necessarily translate to long-term economic value. It can, but the correlation is lower than you would otherwise think and expect. Or said differently, the failure rate of unicorns is much higher than people realize. And one of the things that got embedded within a lot of unicorn media was in a company's attempt to reach for this milestone, they were willing to trade off you know, the type of investor, the way in which that investor engaged, the structure of the deal that they made with that investor, meaning both, you know, heavy preferences that are put on top and or the type of negative controls that this investor or group of investors has you know, the ratchet that it may occur at a time of a public offering, et cetera. Like the list goes on and so, you know, a lot of those dynamics are unhealthy. Clearly it's unhealthy for people to become so heavily focused on, you know, this sort of individual time marker value, whereas this long-term economic value is really what matters. You know, that said, the lists continue and people, and, you know, the nomenclature continues within the press, and I don't think it's going away anytime soon.
No, it's not going away at all.
It exists.
But you are looking for these outsized returns, though, right? You're not looking for the niche opportunities.
Well, look, I think the dynamics of growth investing. By the way, it's not just venture capital, it's not just seed investing, it's not just early stage or later stage, it's all growth investing, including public markets, is that the power law that is significant and applies across the returns, meaning a few things make up nearly all of the returns for a fund, for a firm, for, you know, again, the same thing for public growth funds. And given that, you will always, as an investor, be interested in understanding what company really could be that outside driver. In fact, every venture firm will say, you know, we really only focus on companies that can emerge that way. And that's sort of a byproduct of the notion of a firm, a fund. Now, if you had a structure whereby you were really looking at investments on an individual by individual basis, that may begin to change. I think the importance of the work that we are doing in really rethinking markets is that the power of a niche, for example, to go back to what we talked about on Airbnb, is that, you know, here they were going after and targeting a very specific, behaviorally, not strategically, behaviorally, targeting a very niche segment that turned out to be a very large segment. And what they needed to do was, through different systems, establishing and unlocking that trust so you could unlock this behavior. And that's what, to me, becomes the bridge between someone who believes they're really going after a niche. We are really looking to understand how that niche actually is representative of a much larger segment of the population that not yet has exhibited that type of behavior.
So, you know, I'm a huge fan of niches, and part of it is also there are two ways to look at niches, right? There are, right now in the industry, there are some 600-700 micro VCs, you know, small funds, $10 million funds, $15 million funds, $50 million funds, who are in a position to invest in niches and actually make 3x, 4x on niches, because there is a lot of acquisition opportunity. There are tons of, you know, especially in SaaS, there's a ton of companies that could acquire to grow and stuff like that. So there are exit opportunities within those niches and so forth. So, and there's a fund size, abundance of fund size fit in that segment. So that's one way to play a niche. And the other way to play a niche is the way you're playing it, or proposing to play it, which is to start with a niche and then be able to systematically broaden the niche into a more mainstream, much larger market opportunity. So I think either way you look at it, niche is a very important piece of how to build a company, a very important strategic move in how to build a company.
Yeah, and to be clear, look, again, we also believe niches are really important in that you can go in, have a very specific understanding and target, and overserve that customer group, by which we mean really in creating delight that causes those customers to really become, you know, your ambassadors as you go out. And there's a weighting that most investors and sort of the broader ecosystem of entrepreneurs put against some understanding of TAM, the total addressable market, which, you know, when an entrepreneur comes in and says, here's $1 trillion market, my first reaction is, you don't understand your market.
That's
because
right.
that notion of describing a TAM, that, you know, you've missed the segmentation. So come in and have a very deep understanding of a very specific target. And then for us, we're going to look to understand how that target provides, you overserve that target market. You're now in a position to go do what? And that these nested if-thens create the framework through which you really unlock the full potential of a company.
Very good. Nate, thank you for being with us today and sharing your insights, and look forward to working with you on something soon.
I look forward to it as well. Thank you.